is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with co-host Andrew Young, coming to you from Los Angeles, where I'm in beautiful Santa Monica for the LA launch event of my new book, Web3. Andrew, there's another book in the news these days about our industry, Michael Lewis's book, which is coming out in a few weeks, I believe, about the collapse of FTX and the trials and tribulations of Sam Bankman-Fried. Now, the trial starts this week, or at least the jury selection process, so it's going to be in the news for the next little while. But this book has caused a bit of controversy, and I'd love to understand what the issues are. Can you walk us through it?
Yeah, it's kind of a crazy. So first of all, there's sort of been two controversies. The first is Michael Lewis went on 60 Minutes to promote the book, and he was seen as being sort of overly sympathetic to SBF and Sam. For example, he was talking about how he was sort of making the case that, FTX was actually this very profitable business, and it was kind of just an unfortunate bank run that, set the collapse in motion. When in reality, a lot of the reason why FTX became such a dominant player within the exchange market was that Alameda had been sort of consistently losing money as a market maker on their exchange, which led to a ton of, traders, institutional funds finding FTX to be a great place to trade because effectively they were just, making money off of Alameda. And so in a way,
subsidizing their customers with Alameda funds, right?
Exactly. And so for people who are in crypto, they sort of understand this dynamic that a lot of the growth of FTX was very inorganic. It was entirely subsidized by Alameda's losses, which were only allowed to continue because Alameda had essentially special trading privileges, special liquidation privileges, essentially allowed to go fractional reserve where they didn't have to put up all the money. And so because of that, the exchange itself was effectively fractional reserve, which it should never, ever go. With crypto exchanges.
And just so people understand, like fractional reserve, it's like basically the idea that for every dollar of deposits, the customer deposits, that there may be, more than a dollar of like trading volume or like assets. Like, how does that work exactly? Like from a bank's perspective, a bank takes in a dollar of deposits and makes $10 of loans on the back end. So it's using a fraction of its reserves to create new capital. So how does that work in an exchange context exactly?
Yeah, so centralized exchanges are not banks. They shouldn't lend money to, they shouldn't essentially create capital. They should always be fully collateralized, if not over collateralized, once you take into account kind of like the equity value of the company itself. In the past, crypto exchanges have become under collateralized because of hacks. So, if someone steals the money in the crypto exchange, then of course it's not fully collateralized. And that's obviously a huge issue. But the issue with FTX wasn't that. The issue was that Alameda effectively had this special privilege on the FTX exchange. It could effectively, it didn't have to actually post collateral to trade on FTX. It essentially just got to trade with however much balance it needed. And what ended up happening was during the collapse of in 2022 in crypto, Alameda was effectively acting as the what's called designated market maker. So it was offering liquidity on everything all the time to make sure that the exchange was functional. Yeah. And so when crypto was collapsing, it was constantly buying bad quality assets. So essentially they were on the other side of a bunch of massive losses. And effectively, obviously, when ZZ eventually, called their bluff later on, we don't need to rehash that whole sort of story. But obviously, it sort of proved that Alameda FTX didn't have the funds to actually cover people's withdrawals. Yeah. And again, banks are different because they're government backed, government regulated. They're effectively allowed to go fractional reserve because they have implicit guarantees. They are, like I said, highly regulated. So it's just a much that's obviously how banks are set up. Crypto exchanges are not supposed to be like that. And so, yeah, moral of the story is it was kind of a stupid thing of Michael Lewis to imply.
So he's basically implying well, it's more like an error of omission, right? Like he didn't mention any of this stuff, right? Like it was more just this was a great business, or a business that was growing really quickly. And, if there hadn't been a run on the bank, it would never have collapsed. That's all. That's the quote that I saw. I didn't listen to the whole interview, but it seems like that's very different than what you were telling me.
Yeah, exactly. It's not an accurate description of what happened.
Yeah.
Alameda was subsidized. Like FTX was never a sort of viable business concern once you take into account the fact that its growth was entirely driven by Alameda losses. So that's a very key thing that people need to realize. And so it's not like some business that shouldn't have been that sort of got caught because of CZ calling them out or anything like that. Like it was fundamentally flawed business, and that's actually a big reason why FTX was trying to bail people out during 2022 because they wanted to get access to the customer assets to keep the game going a little bit longer. So, for example, with the Voyager and Celsius and BlockFi. I just want to clear that up. First of all, there's also a ton of other quotes that have come out from the book. I believe the book's called Going Infinite. It just came out yesterday or today. A lot of really crazy stuff around sort of Sam and Caroline, who was the co-CEO of Alameda. Just like they had sort of a personal relationship that they were also trying to hide. There were a lot of kind of crazy quotes have been coming out showing providing a lot more color on, I guess, Sam's personality and just overall how crazy it was at the company.
Yeah, interesting. Well, the case kicks off this week, or at least the jury selection process of it, and that's, I think, causing the media to focus its attention on the trial. The New York Times said that the trial is going to shine a, quote, harsh glare on all in the industry, as if it were a black light on a proverbial hotel bedspread. I think we've seen this before, Andrew, maybe a bit before your time, but I know you were reading the financial press when you were in middle school. So back during the financial crisis, a lot of the media coverage was about how capitalism itself was on trial following the collapse of the banks, or following the Bernie Madoff Ponzi scheme. Like I'm actually pulled a few headlines on this from the New York Times and the Financial Times from that period of time. Also, this trial is being called the trial of the century. We've heard that before too in the case of Enron. And look, I mean, if people do bad things, they should be held to account, and we should, pay a lot of attention to them. I'm not saying we should brush it under the rug by any means, but it's often the case where we sort of paint the whole industry or an emerging technology with a very broad brush of the wrongdoings of any individual person. And I think in a lot of cases, the collapse of FTX is being used, honestly, to justify a lot of concerns that some people have about Web3 in general, that this new technology, while maybe innovative and useful in the hands of a big bank or central bank or central bank digital currency, is a positive. It's a net negative when left to the free market. That all it does is give speculators new ways to gamble and criminals new ways to avoid law enforcement. And even the coverage kind of reflects that, talking about the speculative nature of the asset class. I mean, my view has always been that we can always blame the collapse of companies like FTX, not on the underlying technology, of course, but on the errors and the wrongdoing of the people who are wielding it. And I think that, if anything, my hope is that the trial will act as a punctuation point in the history of this industry in the Web3 era, and that we'll be able to reset the conversation after that, where we're not talking about prominent people and personalities and too big to fail companies. We're talking about how the technology empowers individuals and enables new kinds of projects, companies, networks that weren't possible before, and what that could mean for the economy, for business, for society, and so forth. And so, that's not going to happen in the next 2 weeks. The next 2 weeks is going to be a lot of, tabloid style revelations about, secret diaries and all this other nonsense. But big picture, this is going to, I think, be in the rear view, and we'll be, back at it, trying to figure out how to position this industry and understand and help people to understand why it's important, right?
Yeah, I totally agree. I think, I'm ready to close the book on this chapter, and sort of move on to better and brighter things. One of which actually just came out today, I believe, yesterday on Monday, as you correctly predicted, I think 2 weeks ago on this pod. Do you want to just talk about sort of that prediction and what came out?
Oh yeah, well, a lot of people were talking about how Bitcoin ETF is going to be good for Bitcoin, and the Bloomberg analysts and other prognosticators have the odds at 75% by the end of the year. And people are thinking, okay, what does that mean for Bitcoin? And my view is that it could be very material. We saw this in Canada, how the launch of a Bitcoin ETF did lead to very significant buying. But I think the bigger opportunity potentially was with Ethereum, and specifically with the Grayscale Ethereum Trust, which is ETHE, trades over the counter in the US. Now, Grayscale in the past has said that it intended to convert all of its crypto asset trusts into ETFs at some point, but didn't really initiate that process. And today, they did that with the Ethereum ETF. They said, we're going to convert this into ETF. So basically, my argument last week in CoinDesk's Long Short newsletter, and also on our podcast, maybe even earlier than that, was simply that, yeah, look, I mean, if the Bitcoin ETF gets approved, then an Ethereum ETF is not going to be far behind it. The regulators in Canada approved the Ethereum ETF within weeks of the Bitcoin ETF. And one of the reasons for that was that the Ethereum market has a regulated futures market. And so that allows market makers to sort of hedge their underlying risk while creating and redeeming units. So basically, like, for people who are not familiar, that's sort of a little market structure thing where, if you're if you're like a market maker for a fund, you may take directional positions on the asset, but in general, you just want to sort of clip your spread, every single time as a way to, make money. So it's a volume game. The more you do, the more you make, but you don't want to be taking directional bets. And with a futures market, you can, hedge the underlying risk. So anyway, so that's just a little bit of background. So that kind of market doesn't exist for anything other than Bitcoin and Ether, but it does exist for Ether. So what that means is that, once an ETF, a spot ETF goes live, there actually would be like counterparties and vendors that exist to help it to function. So to make a long story short, the Bitcoin ETF, the Bitcoin Trust spread has narrowed from, I think, as high as almost 50% earlier this year to, I think, around 23. And the Ethereum ETF spread, Ethereum Trust spread has narrowed as well to about 29%. But, there's no reason why, in my view, it should trade at a huge discount because I think that one will follow the other. And the other thing too is that, just sort of big picture, like what's more likely to move the needle? If is $1 billion of Bitcoin volume going to move the needle as much as $1 billion of incremental Ethereum buying? Now, I don't think it'll be like quite the exact same, but I just think that the market is a little tighter, smaller, more concentrated, and I think the impact on the price could be much more material. Is sort of point number one, and then point number two is that big picture. I think for me, I just have more belief that Ethereum is going to grow significantly in the next little while compared to Bitcoin. I love Bitcoin. We launched a Bitcoin ETF. We're one of the first in the world to do it. And, Bitcoin is something we've talked about a lot on the show. It's got a $500 million market cap. So you have to think like, well, what's the upside from here? Ethereum, on the other hand, is a platform that I think could be eventually, a platform that rivals Web2 platforms. So, $2 trillion and it's $200 billion. So I think it's just got more upside between now and sort of whatever the next sort of future date we're looking at in this cycle. And I think that this ETF gives investors exposure to that. And so I think that, taken as a whole, if you're looking at ETHE trading at a 29% discount or GBTC trading at a 21% discount, and you've got sort of a neutral view to a slightly positive view on Ethereum, then the Ethereum one, I think, looks pretty attractive. It's not investment advice. It's just like a comparison of the math between the two different products. So yeah, I mean, this is an interesting thing because on Monday, October 2nd. So we saw that the Ethereum futures ETFs launched. And there was a lot of chatter over the weekend about how this was going to, be a big deal for buying of, Ethereum. And like, I think what people fail to understand is that there is no buying of Ethereum or Ether because it's not a spot ETF. It's a futures ETF. Now, like, there's a knock-on effect. If it ended up having a huge open, people would get maybe more bullish and decide to step into the spot market. But that's not what happened. We saw, a couple $1 million of creations, which is actually not bad for an average ETF launch. But like Bitwise's futures ETF, I think had a $200 million day one. So that just puts it into context. And then of course the spot ETFs are in my view, the holy grail, because we have proof of this in Canada. When the Purpose Bitcoin ETF launched, I think it launched with $500 million, maybe more, on day one, and it was like a couple $1 billion within a week. So it just blew these US ones out of the water. And this is just a Canadian ETF. Now, a lot of the buyers for the Canadian spot ETF were American, but the rules in Canada say that you can only have up to 50% of the shareholders be foreign entities, right? So we know that at least half is Canadian. So that just helps to put the scale of the market into perspective. And so I think, where are we headed from here? Well, the SEC has dragged its feet. It's delayed more of these approvals. But I think that at this point, my feeling is that it's a matter of when, not if. And, when that happens, I think Ethereum, perhaps counterintuitively, could actually be the biggest winner.
Yeah, that's interesting. I mean, I think, so just two things that sort of made me think of. One is, it's interesting that it's now been almost exactly a year, just a little bit over a year, since the merge went live on Ethereum. And since then, Ethereum's actually underperformed Bitcoin by, I think, like 20%, which is really surprising, given that with the merge, Ethereum became almost like, I haven't actually checked, but it's like roughly, it's not deflationary, but it's effectively, its inflation got cut to zero. And there's obviously like a 5% yield to the asset. So I guess, first of all, it's interesting that the merge didn't lead to outperformance. And the reason why I bring that up is one of the things that's kind of going around right now on crypto Twitter is the launch of this Ethereum futures ETF was sort of so below expectations that people are now worried that the sort of spot Bitcoin ETF launch will be similarly disappointing. Which
that's interesting. Yeah.
Yeah, that's kind of like, I mean, again, sort of these are the crazy parallels that crypto people are drawing. But it is interesting that to me, like I first got really excited about crypto, just like from a number go up sort of perspective, when I realized that there was no Bitcoin ETFs lit yet. Once those come online, obviously Bitcoin will go up because it's such a huge friction point. I was way over optimistic on the timeline. That was 6 years ago, back when I was sort of working in TradFi. But I'm almost wondering if the Bitcoin ETF launch, just because Bitcoin itself, I mean, it's been, interestingly enough, over the last year, it's probably been one of the best performing assets in the world. It's up like roughly 50-60% from its lows. But there's not that much hype around it right now in sort of the traditional financial markets. And so I wonder if the Bitcoin ETF launch itself will be a bit of a dud, just because there's no one really FOMOing into it.
Yeah.
And also there's a lot of people who are doing this, GBTC ARB, who theoretically, will have to unwind the trade if the ARB sort of closes. So I'm this kind of launch was so below expectations in terms of the amount of assets that I just think it's sort of put it's made, from what I've seen, it's made people sort of readjust their expectations on spot ETF.
Yeah.
I'm curious if you share that. I mean, I know you were talking about how spot ETFs are obviously a way different beast than the futures ETF, but if there's no kind of underlying demand in the institutional markets, then does it really matter?
Yeah, I think that's a fair point. I think that they are different. And I think obviously the context of the market clearly matters quite a lot. Which is basically that, all of the data that I'm providing, even the Bitwise ETF, futures ETF, or the Purpose ETF did launch in a bull market. And so we're in a different kind of marketplace right now. And what will that demand look like? I'm not totally sure, but what I can say is that if companies like BlackRock and others are looking to launch these things, it's clearly because they see that there's some potential for significant demand. And I do believe that the US retail marketplace is a very large and untapped one, and that there are lots of people who are interested in the asset class, put it to you that way. And I think that, look, there's a lot of problems with the futures ETF. There's roll risk. There's also just the mere fact that, people are getting exposure to futures, not the underlying asset. And there's something to be said for having exposure to the underlying asset. And so I think, in my opinion, that that's got some validity, but I wouldn't read into that too much. And I also think that, the Ethereum, futures ETF didn't launch from some major mainstream players. VanEck was one of them, but it didn't have quite the same kind of backing. So I think that matters for a lot. That counts for a lot too. So I don't know. We'll see. I'm thinking about it now. Now you've got me thinking a little bit, Andrew, which is good. Always good to question your priors on these kinds of things. I've been thinking about it in one way for quite some time. Anything else? Yeah, sorry, go ahead.
Yeah. Just before we move on, I do think I really want to emphasize that other point, though. I think the fact that Ethereum got a futures ETF out sort of solidifies that I think Ethereum, will now get a spot ETF out, and it sort of insulates Ethereum from this sort of tail risk of the SEC deeming it a security. Just because I think, not that was sort of a big risk, but during kind of when the SEC was kind of coming hard on crypto projects, there was some talk that they might even come after Ethereum. So I think that this sort of puts that all to rest. There's the fact that the SEC allowed it. And it also obviously clears the way for the Ethereum spot ETF. So yeah, I think it's very bullish Ethereum, but it's bullish Ethereum but the launch of the futures ETF was sort of underwhelming. So
exactly.
Is there anything else you want to talk about? There was a couple other headlines that hit the tape.
Well, there was one thing I thought was kind of interesting, which is just that apparently there was a leak out of Microsoft during this FTC antitrust case about them wanting to include a crypto asset wallet into the Xbox sort of ecosystem, which I thought was very interesting. We've discussed a lot how we think gaming is a good on-ramp to Web3 and to, digital asset ownership. The idea that people are already spending billions of dollars on virtual goods in these environments. And so if you're going to buy it, you might as well own it, And so I thought that was a very interesting thing and could obviously be a huge unlock to drive people into the platform. But, we've seen lots of examples of companies talking that angle before. It doesn't mean it's going to happen or it's going to be, forthcoming anytime soon, but just an interesting data point. But other than that, that's really it for today, Andrew. It's a couple interesting things worth talking about. We'll obviously be following this trial closely, I guess, insofar as there's any, things we need to correct or clarify for our listeners who I know are interested in it. But otherwise, we'll keep on talking about the big, the big stories and the big themes and ideas that we think are important for people to understand. But until next time, that's really it for DeFi Decoded. Thanks everybody for joining, and we'll see you next time.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.